Welcome back to the Sleepy Computer Scientist, where we explore the universe of ideas one gentle thought at a time. Tonight, we're drifting into something a little different, something that exists not in the cosmos above us, but in the world of money, ambition, and artificial intelligence. Tonight, we're asking a question that sounds almost simple at first, but the deeper you fall into it, the more it stretches your mind like a financial web pulled taut. Can one person's empire, built on dreams of electric cars and rocket ships and artificial minds, survive the collapse of something it doesn't even entirely depend on? Can Elon Musk's vast constellation of companies weather the storm of an AI bubble bursting? It's a curious puzzle, isn't it? A bit like asking whether a spider's web can survive when just one thread breaks, except in this case, that one thread might be connected to every other thread in ways we don't immediately see. And maybe, just maybe, by the time we've wandered through all the numbers and interconnected threads tonight, you'll drift off to sleep with a clearer picture of how fragile even the mightiest empires can be. Or perhaps you'll stay awake, captivated by the strange economics of it all, the way money flows through our world like water through ancient riverbeds, carving paths we can only see when we step back far enough. Either way, settle in, get comfortable, adjust your pillow, dim the lights if you haven't already. And before we begin our journey tonight, I'd love to know where you are right now, in this particular moment in space-time. Drop a comment below telling me where you're watching from and what time it is there. Are you in Melbourne watching the morning sun paint your walls gold? In Chicago as the evening settles in? In Mumbai as midnight approaches? It helps me imagine all of you out there, scattered across the world like stars in a constellation, thinking about the same strange questions together, connected by nothing more than curiosity and the gentle glow of your screens. And if you enjoy these slow explorations into the oddities of our world, these long meandering paths through complex ideas, do me a kindness and hit that like button down below. Subscribe if you haven't already. Ring that notification bell if you want to be alerted when we explore something new next time. Let the algorithm know that contemplative content still has a place in this frenetic digital age, that not everything needs to be 8 minutes long and hyperactively edited. I promise I won't mind if you fall asleep halfway through. That's what we're here for, after all. In fact, it's kind of the point. You have my permission to close your eyes whenever they feel heavy, to let your mind wander, to drift away on the gentle current of words and ideas. Now then, let's begin with what seems obvious, shall we? Most AI companies right now, the big names you hear about in the news, OpenAI and Anthropic and all the others promising to revolutionize everything from customer service to creative writing. They're burning through money like it's going out of style, like sailors on a ship made of gold, tossing handfuls of coins into the sea, hoping to summon favourable winds. They raise enormous sums through debt and equity, billions upon billions upon billions, all to fund operations that aren't actually profitable. Not yet, anyway. Maybe not ever. It's a classic bubble pattern, really, one we've seen before in history. A bit like the dot-com days at the turn of the millennium, when everyone was so certain the internet would change everything, which it did, to be fair, but they forgot to ask whether the companies building it could actually make money in the process. Back then, you could slap .com on the end of any business name and watch investors throw money at you. Pets.com, Webvan, Cosmo. Companies that made no economic sense whatsoever, that were built on the assumption that fundamental laws of business, things like revenue and profit margins, somehow didn't apply anymore because we had this shiny new technology. And then, of course, the bubble popped. The Nasdaq lost nearly 80% of its value. Trillions of dollars just evaporated like morning dew under a harsh sun. Companies that had been valued at billions went bankrupt overnight. Even good companies that would eventually become giants, lost 90% of their value. Amazon survived, but not before dropping from over $100 a share to just $6. Imagine being an investor watching that happen. But here's where it gets interesting with our current situation. Elon Musk's approach looks different on the surface, doesn't it? Take Tesla, for instance. Its artificial intelligence development, all those promises of full self-driving and humanoid robots wandering through your house doing chores, that's funded by selling actual cars to actual people. Real revenue. Not venture capital wishful thinking, not PowerPoint presentations to investors about the glorious future. Actual tangible products that drive down actual roads. So you'd think, wouldn't you, that when the bubble finally pops and the money dries up for everyone else, Tesla would be the last one standing. The tortoise that kept plodding along, selling cars while the hares collapsed in exhaustion, gasping for funding that no longer exists. That's the common wisdom, and it sounds reasonable. It has that ring of truth to it, that satisfying narrative of the practical businessman outlasting the dreamers. But here's the thing about common wisdom, and this is something worth remembering as you drift off to sleep tonight. Common wisdom is often missing a few crucial details. Little things. Technical things. The kind of details that don't make it into headlines but that determine whether empires stand or fall. Details that, when you add them up slowly and carefully, paint a very different picture than the one you see at first glance. So let's dig into those details, shall we? But first, and this is important, we need to set some ground rules, some assumptions we're working with, because we're talking about hypotheticals here. We're imagining a future that hasn't happened yet. We're building a model, and like all models, it's only as good as its assumptions. Think of it like building a little universe in a computer, one where you get to set the initial conditions and watch what happens. Except in this case, our universe is made of corporate debt and stock valuations and the peculiar psychology of markets. So here's what we're assuming tonight, our initial conditions, if you will. First, and most fundamentally, we're assuming the AI bubble will burst. Not might burst, will burst. And when it does, it'll be spectacular. A fireworks display of lost fortunes and shuttered companies and investors wondering how they could have been so foolish. Think of the dot-com crash, when the Nasdaq lost nearly 80% of its value over 2 years. Think of all those companies that seemed invincible in 1999 and didn't exist by 2002. AI stocks, the companies valued on the promise of artificial general intelligence and revolutionary productivity gains, and machines that can think like humans, they'll see similar devastation. Maybe worse, because the valuations are even more disconnected from reality this time around. Second, we're assuming this triggers a debt crisis, a big one. JP Morgan, not some fringe analyst, but JP Morgan, has pointed to over $1.2 trillion in AI-linked debt. That's trillion, with a T, 12 zeros. More money than most of us can really conceptualize. Try to imagine it. If you spent $1 million every single day, it would take you over 3,000 years to spend $1 trillion. You'd have to start spending during the Bronze Age and continue through the rise and fall of empires, through the Renaissance and the Industrial Revolution, all the way to today. That's how much debt we're talking about tied to AI companies and their promises. When companies default on that debt, and they will if the bubble pops because they have no way to pay it back, it creates a cascade, a domino effect. One company defaults, which hurts the banks that lent to them, which makes those banks tighten lending to other companies, which causes more defaults, which creates panic, which freezes capital markets entirely. It's a 2008-style financial crisis, except this time centered on artificial intelligence instead of housing. Money becomes expensive, trust evaporates, the lubricant that keeps the global economy running smoothly turns to sand, and the gears start grinding against each other. Third, and this follows naturally from the second, raising new capital becomes brutally difficult, if not impossible, for speculative ventures. When investors have been burned badly enough, they retreat to safety. They stop betting on the future and start hoarding cash and government bonds. The venture capital that flows so freely now, the private equity deals, the special purpose acquisition companies, all of it dries up. Companies that need constant infusions of new money to survive, even companies with good ideas and talented people, they suffocate. It's not about whether your technology works anymore. It's about whether anyone will give you money to continue developing it. And fourth, and this is important, perhaps the most controversial of our assumptions, we're assuming Musk's AI ambitions fail. Optimus, the humanoid robot that's supposed to be doing your laundry and cooking your meals, full self-driving, the technology that's been perpetually 2 years away for the past decade. Robotaxis, autonomous vehicles ferrying people around cities with no human oversight. Grok, his answer to ChatGPT, his attempt to have his own large language model. Even Starship, though, that's technically space travel, not AI, but it's still a Musk venture that depends on future promises rather than current capabilities. We're assuming they all fail because, and this is the key insight here, they don't have the fundamentals to succeed. They're built on optimistic assumptions about technological progress that may not pan out. Now, I'm not going to spend tonight explaining why each one faces insurmountable technical challenges. That would be a different video entirely, probably several videos actually, because the physics and engineering problems are substantial and fascinating in their own right. But if you've followed along before, if you understand things like the computational complexity of real-world perception, the battery energy density limitations, the control theory challenges of bipedal locomotion, the thermal management issues in orbital refueling, you know why these promises are so ambitious, so improbable, so much harder than they sound in a press conference or a tweet. Okay, premises established. Our initial conditions are set. Our hypothetical universe is ready to run. Let's start with the easiest target, shall we? The most obvious casualty when the bubble bursts. xAI, Musk's artificial intelligence company, the one that exists almost as a monument to ego and spite. Let's be honest here, because we're among friends and you're probably getting sleepy anyway, so we can speak plainly. xAI exists because Musk felt slighted by OpenAI. He was one of the founders, one of the early backers, and he wanted control. Total control. The kind of control where his vision becomes the company's vision, and everyone else falls in line. He didn't get it. The other board members, people like Sam Altman and the researchers who actually built the technology, they wanted OpenAI to remain independent, to be guided by safety concerns and research ethics, rather than one person's whims. So Musk left, or was pushed out depending on who you ask, and decided to build his own rival, xAI. Except here's the problem. When you're years behind in a technology race, when the other company has already trained models on vast data sets and assembled teams of world-class researchers and built relationships with major corporations, catching up is extraordinarily difficult. It's not impossible, but it requires either a fundamental breakthrough that leapfrogs the competition, or just throwing absurd amounts of money at the problem until you brute force your way to parity. Musk chose the second option, because of course he did. That's his entire playbook, really. Spend money aggressively, move fast, Worry about sustainability later. xAI is essentially OpenAI, but a few years behind and with models that, if we're being honest, aren't quite good enough to justify the hype. They're not bad, they're competent. But competent doesn't win in the AI race when your competitor is already embedded in Microsoft Office, and ChatGPT is a verb now like Google or Xerox before it. OpenAI stays afloat by constantly raising money, billions in equity, billions in debt, a perpetual fundraising machine that burns through cash, developing new models and building compute clusters, and paying researchers salaries that would make investment bankers jealous. xAI does the same thing, though it also gets some internal funding from Musk's other companies. And this is where the numbers start to get interesting, where our hypothetical future begins to take shape. xAI started with $10 billion in equity investments. Think about that for a moment. $10 billion. That's more money than the GDP of several small countries. That's enough to fund a decent-sized war or build a small city from scratch. And that was just the start. Now xAI is looking to raise another $12 billion in debt. 12 billion more. 22 billion total for a company that's playing catch-up in a market that might not even exist in its current form a few years from now. And that internal funding from SpaceX and Tesla, the money that supposedly insulates xAI from market conditions, it only makes up about a quarter of xAI's total capital, maybe less. Do the math with me here, slowly, because this is where it gets interesting. If 3/4 of your funding comes from external investors, and those investors disappear when the bubble bursts, you need to replace that funding from somewhere. For xAI to survive on Musk's money alone, he'd have to quadruple his internal contributions, 4 times what he's currently providing. That's not a small ask. That's not a matter of tightening belts or finding efficiencies. That's a fundamental restructuring of his entire financial empire. And here's the kicker, the detail that makes this nearly impossible. That $5 billion investment from Tesla, the bulk of his internal funding, it might get blocked by shareholders. Because here's a question that reasonable people are asking. Why is a car company funding an AI startup? What's the strategic rationale? How does this benefit Tesla shareholders rather than just Musk personally? And when shareholders start asking those questions, when they start filing lawsuits and demanding board accountability, companies tend to retreat. The money dries up. So when the bubble pops, when external capital markets freeze up and investors stop throwing money at AI companies because they've been burned too badly, xAI loses access to the majority of its funding. It can't raise new equity because no one wants to invest in an AI company anymore. Not after the crash. It can't raise new debt because lenders have been burned on AI-linked loans and they're not making that mistake again. And it can't get enough from Musk's internal sources because he simply doesn't have the capacity to quadruple his contributions without destroying his other companies. The result is inevitable. xAI runs out of money. It starts cutting costs, laying off researchers, shutting down compute clusters. But these things have momentum. You can't just pause AI development like you pause a video. The researchers find new jobs at companies that still have funding. The institutional knowledge scatters. The competitive moat, already thin, disappears entirely. And since xAI also owns Twitter, which hemorrhages money like a ship with a hole in the hull, the whole thing collapses under its own weight. It's a house of cards built on speculation, and speculation is the first thing to vanish in a crash, like morning dew when the sun comes up. Twitter itself deserves a mention here, because it's almost a microcosm of everything wrong with Musk's approach to business. He bought it for $44 billion, a price that was probably too high even before he started making changes. Then he gutted the workforce, fired most of the engineers and content moderators, alienated advertisers with chaotic policy changes and his own increasingly erratic behavior on the platform. Revenue dropped. Costs stayed high. The debt payments alone, the interest on the loans he took out to buy Twitter, are staggering. And here's the thing about debt. It doesn't care whether you're having a good year or a bad year. It doesn't care whether the market has turned against you or whether your other companies are struggling. Debt has to be paid month after month, like clockwork, or the lenders come calling. When XAI collapses, it takes Twitter with it, because they're owned by the same entity, and the debt is probably cross-collateralized. The lenders, seeing XAI fail, will demand repayment from any available assets. Twitter, despite its cultural importance and its role in shaping public discourse, becomes just another asset to be liquidated. But XA and Twitter, as catastrophic as their collapse would be, they're almost too easy. They're obviously vulnerable. Anyone looking at the numbers can see the problem. Let's move on to something more interesting, something where the conventional wisdom says Musk is safe. Let's talk about Tesla. Tesla, the crown jewel. The company that made Musk the richest person in the world, at least for a while. The company that proved electric cars could be desirable, that challenged the entire automotive industry to change course, that sparked a revolution in transportation. Tesla's situation looks better at first glance, doesn't it? Its AI projects are funded internally by car sales, real revenue from real products. The company spends over $11 billion a year on capital expenditures, including AI research, autonomous driving development, robot prototyping, battery technology, manufacturing expansion. But it has the revenue to cover that. In a good quarter, Tesla makes billions in profit. It can absorb the loss of its AI investments. A bubble bursting won't kill Tesla directly. It can weather that storm. But here's what will kill it, or at least what will kill Musk's control over it: market revaluation. And this is subtle. This is the kind of thing that doesn't make headlines until it's already happened. But it's absolutely crucial to understanding how vulnerable the empire really is. For years now, Tesla has been valued not as a car company, but as an AI company, or a tech company, or a robotics company, or an energy company. Pick your narrative. The point is, investors have given Tesla a valuation that assumes it's going to be much more than just an automaker. That's why its market capitalization has been so absurdly high compared to traditional automakers. At its peak, Tesla was worth more than all other car companies combined, despite selling a tiny fraction of the vehicles. Toyota sells 10 million cars a year. Volkswagen sells 8 million. Ford, GM, Honda, they all sell millions upon millions of vehicles. Tesla sells maybe 1.5 million. Why the massive valuation difference? Because people aren't buying Tesla stock based on how many cars it sells today. They're buying based on what they believe it will be tomorrow. They're betting on a future where Tesla isn't just selling vehicles, it's selling autonomous transportation networks where you summon a robotaxi and it appears at your door. They're betting on Optimus robots in factories and homes. They're betting on energy storage systems that revolutionize the power grid. They're betting on solar roof tiles and battery swapping and all the other moonshot ideas Musk has floated over the years. It's a beautiful vision, I'll give him that. It's the kind of vision that captures imaginations and opens wallets. But it's also a house of cards because it depends on all those things actually working. And working not just in a laboratory or a controlled demonstration, but working at scale, economically, in the real world with all its messy complexity and edge cases and things you didn't anticipate. When the AI bubble bursts, that entire narrative collapses. Investors will revalue Tesla as what it actually is right now, in this moment, stripped of all the promises and possibilities. A car company. A company that makes electric vehicles, quite good ones actually, but still just cars. And car companies are valued on their profits, not their promises. Car companies are mature, low-margin businesses where you compete on manufacturing, efficiency and dealer networks and brand loyalty. They're not magical growth stocks where the sky's the limit. Let's put some numbers to this because numbers make it concrete. Toyota, one of the most successful automakers in the world, a company that's been profitable for decades and sells high-quality vehicles across every market segment, has a price-to-earnings ratio of around 8.24. That means the company's market value is about 8 times its annual profit. If Toyota makes $10 billion in profit, it gets valued at $80 billion or so. That's typical for the industry. That's what investors think car companies are worth. Tesla's profits are falling, not rising, which is concerning for a company that's supposed to be in a growth phase. But let's use current numbers. Let's be generous. If Tesla gets valued like Toyota, with a similar PE ratio, if investors say, okay, this is a car company, and we'll value it like we value other car companies, its market cap drops to around $126 billion, maybe less if profits continue declining. That's less than 10% of its current value. Now, that alone doesn't destroy Tesla as a company. It would still exist. It would still make cars. It would still have factories and employees and customers. A $10 billion valuation loss doesn't make your factories disappear or your cars stop working. But it destroys Musk. And here's why. Here's the mechanism that turns a market revaluation into a personal catastrophe. Musk has used over half of his Tesla shares as collateral for loans. This is common practice among billionaires, actually. You don't want to sell your shares and pay capital gains taxes, so instead you borrow against them. The bank says, you have $1 billion in stock, we'll lend you $500 million, and you just pay us interest. It's a way to access your wealth without triggering a taxable event. It works great as long as the stock price stays stable or goes up. But when the stock price goes down, especially when it goes down dramatically, the math changes. We're talking about $94 billion in loans backed by Tesla stock. $94 billion. That's a number so large it's almost meaningless, but try to wrap your mind around it. That's enough money to end homelessness in America. That's enough to build 100 hospitals or 1,000 schools. That's enough to fund NASA for several years. And it's all backed by the value of Tesla shares that Musk owns. When Tesla's value drops by 90%, when the market decides it's a car company worth $126 billion instead of an AI company worth over $1 trillion, that collateral suddenly isn't worth enough to cover the loans. The math is straightforward. If $94 billion in loans is backed by shares that are suddenly worth only, let's say, $30 billion, there's a massive gap. The lenders are sitting on loans that have no real backing anymore. They're exposed. They're at risk of massive losses if Musk defaults. So they panic. Of course they panic. Lenders don't like being exposed. They don't like uncertainty. And they have a tool to protect themselves, a mechanism written into every loan agreement for exactly this situation. It's called a margin call. They demand immediate repayment in full, not over time, not with a payment plan, immediately, all $94 billion, right now. And here's where it gets truly catastrophic. Even if Musk sold every single share he owns in Tesla, every last one, even if he liquidated his entire position in the company he built from nearly nothing, he couldn't cover it. The math doesn't work. If his shares are only worth $30 billion after the revaluation, and he owes $94 billion, where does the other $64 billion come from? His other companies? SpaceX is private, hard to liquidate quickly, and probably facing its own crisis, as we'll discuss. XAI is collapsing. Twitter is worthless or maybe even negatively valued once you account for its debts. He's locked in, trapped in a financial prison of his own making. The very thing that made him wealthy, that allowed him to build this empire leveraging his assets to fund his ambitions, becomes the mechanism of his downfall. It's almost Shakespearean, really. The tragic flaw that was a strength in good times becomes fatal in bad times. When the bubble bursts and Tesla's value collapses, Musk loses control of the company he built. The lenders take over. They force a sale of his shares to recover what they can. He's forced out, gone. And if Tesla survives, which it might because the underlying business of making electric cars is actually viable, it'll be without him at the helm. New management, new strategy, probably a refocusing on the core business of manufacturing vehicles profitably, rather than chasing every moonshot idea that crosses someone's mind. It's poetic, in a dark sort of way. The richest man in the world, brought down not by the failure of his companies, but by the financial structure he built to fund them, undone by leverage and over-leveraging and the assumption that Tesla's stock price would only go up. History is full of people who made that assumption. It rarely ends well. But we're not done yet. We haven't even talked about SpaceX, and that's where things get really interesting, because the connection to the AI bubble isn't obvious at first. You have to think it through, trace the threads, follow the money through its twisting path. You might think SpaceX is safe, right? It has nothing to do with artificial intelligence. It's rockets and satellites and dreams of making humanity a multi-planetary species. It's engineering, physics, material science. What does any of that have to do with large language models and neural networks and the AI hype cycle? On the surface, nothing. SpaceX could continue launching satellites and resupplying the International Space Station, regardless of what happens in Silicon Valley boardrooms. But here's the connection you might not have considered, the thread that ties it all together. When the AI bubble triggers a financial crisis, when that $1.2 trillion in debt defaults, and the market seize up like an engine without oil, speculative investment dies. Not just in AI, everywhere. The money that flows into high-risk, high-reward ventures, the venture capital and private equity and special-purpose acquisition companies, all of it evaporates. Investors retreat to safety, treasury bonds, blue-chip stocks, real estate in stable markets. They stop betting on the future and start hoarding whatever wealth they have left. And SpaceX, for all its accomplishments, for all the remarkable engineering it's achieved, runs on speculative investment. It always has. Specifically, it runs on Starship, that massive rocket, the one that's supposed to revolutionize space travel and make Mars colonization feasible and reduce launch costs to the point where space becomes economically accessible for all kinds of new ventures. Starship is the keystone of SpaceX's entire strategy, the thing that makes everything else work. And Starship is purely speculative. It's a bet on a future that hasn't happened yet. It's billions of dollars already spent, with billions more needed, all for a vehicle that hasn't successfully completed its mission profile. Now, don't misunderstand me. The engineering is impressive. The test flights have shown promise, but promise isn't the same as delivery, and delivery at scale is yet another level of difficulty. Starship development has probably cost north of $10 billion by now, maybe more. The exact number is hard to pin down because SpaceX is private and doesn't report detailed financials, but you can estimate based on the test flight frequency, the manufacturing facilities they've built, the engines they've developed, the workforce they've hired. 10 billion is probably conservative, and it's not even close to finished. The vehicle flies, sort of, but the hardest parts remain unsolved. Orbital refueling, which is necessary for any deep space mission. Heat shield reliability for multiple reuses. Rapid turnaround between flights. These aren't minor details. These are fundamental capabilities that determine whether Starship is revolutionary or just another expensive rocket. To continue development, to solve these problems, SpaceX needs a steady supply of billions in investment funding every year. Maybe 3 billion, maybe 5, maybe more, depending on how quickly they want to move and how many test articles they're willing to destroy in the learning process. That money has to come from somewhere, and historically it's come from investors who believe in the vision, who are willing to fund today's losses for tomorrow's gains. After the AI bubble bursts, who's going to fund that? Who's going to write checks for billions of dollars to support development of an unproven vehicle for a market that doesn't quite exist yet? Investing in Starship is pure speculation. It's a bet that space transportation costs can come down, that demand will materialize at those lower costs, that the technical challenges can be overcome, that the regulatory environment will be favorable, that the market timing is right. That's a lot of ifs. And in a post-crash world, investors don't like ifs. They like certainty. They like cash flow. They like proven business models. That market, the speculative investment market that keeps SpaceX growing, disappears. It doesn't contract. It doesn't get harder. It vanishes, like morning fog when the sun rises. And when that happens, SpaceX has to make a choice. Either continue Starship development at a drastically reduced pace using only internal funding, or suspend it entirely and focus on the core business of Falcon launches. It's like a row of dominoes stood on edge. Each domino is stable on its own, but arrange them in a line with just the right spacing, and knocking over the first one brings down the entire sequence. The AI bubble is that first domino. XAI is the second. Tesla's revaluation is the third. The margin call is the fourth. SpaceX's funding crisis is the fifth. And so on, each failure triggering the next, each collapse making the subsequent collapses more likely and more severe. And here's what makes it truly concerning, what keeps me thinking about this late at night when I should be sleeping. Nobody seems to be talking about this. All the analysis you see focuses on individual companies in isolation. Will Tesla succeed with full self-driving? Will SpaceX make it to Mars? Will XAI catch up to OpenAI? These are the questions people ask. But they're missing the forest for the trees. The real question, the systemic question, is whether the entire interconnected structure can survive a major shock. And the answer, when you look at it carefully, appears to be no. This isn't unique to Musk, by the way. This kind of vulnerability exists throughout the modern economy. We've built systems of extraordinary complexity, systems where everything is connected to everything else through financial instruments and debt obligations and supply chain dependencies. These systems are efficient when things are running smoothly, but they're fragile when stressed. A shock in one place propagates everywhere else. The 2008 financial crisis demonstrated this. A problem with subprime mortgages in Florida ended up bankrupting banks in Iceland and tanking stock markets in Japan. Everything is connected now, and connection creates vulnerability as much as it creates strength. The AI bubble has these same characteristics. It's not isolated, it touches everything. Tech companies, obviously, but also the banks that lend to them, the investors who fund them, the suppliers who build their hardware, the energy companies that power their data centers, the real estate markets in Silicon Valley and Seattle and Austin where everyone wants to live. When it pops, and bubbles always pop eventually. The effects will ripple outward through the economy in ways that are hard to predict, but easy to understand in broad strokes. Credit tightens, investment slows, hiring freezes, projects get cancelled, and anyone who's overextended, anyone who's borrowed against future growth, anyone who's dependent on continued access to capital, finds themselves in trouble. Musk is perhaps the most overextended person on the planet. That's not hyperbole. That's just an assessment of his debt-to-asset ratio and his dependence on continued high valuations. He's bet everything on continued growth, continued access to capital, continued investor belief in his vision. And in good times, that strategy looks brilliant. It's let him build multiple companies simultaneously, pursue multiple moonshots, move faster than competitors who are more cautious with their capital. But in bad times, and a bubble bursting creates very bad times, that same strategy becomes suicidal. The leverage that amplified his gains on the way up will amplify his losses on the way down. It's a fundamental principle of finance, one that's been known for centuries. Leverage cuts both ways. It's a sword with two edges, and you can't wield it forever without eventually cutting yourself. There's something almost Greek tragedy about it if you think about it. The hero undone by his greatest strength. Musk's willingness to take enormous risks, to bet everything on his vision, to leverage every asset to pursue the impossible. This is what made him successful. This is what allowed him to achieve things that everyone said couldn't be done. But it's also what makes him vulnerable now. The same trait that was an asset becomes a liability when conditions change. And maybe there's something oddly comforting in that recognition, in seeing that even the mightiest empires have invisible fault lines. It reminds us that nothing is permanent, that all things change, that the world is more fluid and uncertain than we like to pretend. It's the same lesson we learn when we study history, when we look at empires that seemed invincible in their time, but exist now only in textbooks and archaeological sites. The Romans thought their empire would last forever. They called the Mediterranean our sea, and couldn't imagine a world where Rome wasn't the centre of civilization. And yet here we are, 2,000 years later, and Rome is a tourist destination, not the capital of the world. The British Empire, on which the sun never set, dissolved in the span of a few decades after World War II. The Soviet Union, that seemed so permanent and powerful, collapsed almost overnight when the internal contradictions became unsustainable. And we have modern empires now, built not on land or conquest but on market capitalization and investor confidence. They're no less impressive than ancient empires in their scope and influence. But they're also no less fragile, maybe more so, because at least ancient empires had physical territory and agricultural production. Modern corporate empires have quarterly earnings reports and stock prices that can change by billions in a single trading session based on nothing more than sentiment and fear. It's worth contemplating what this means for how we think about wealth and power and permanence. We tend to look at billionaires, at successful entrepreneurs, at people who've built massive companies, and we assume they're secure. We assume that kind of wealth brings in vulnerability, that you can't lose that much money, that there are safety nets and backstops and ways to protect yourself. And to some degree that's true. Musk will never be poor in any meaningful sense. Even if everything collapses, even if he loses control of all his companies, he'll still have more money than most people see in a lifetime. But he can lose his empire. He can lose his influence. He can lose his ability to pursue his vision. And for someone like Musk, for whom the mission seems to matter more than the money, that's probably a more devastating loss than mere bankruptcy would be. The tragedy isn't that he'd be poor. The tragedy is that he'd be powerless to continue the work he thinks is important. There's a deeper question buried in all of this, one that I think is worth sitting with for a moment as we near the end of our journey tonight. What does it mean to build something that lasts? What does sustainability really require? We talk a lot about sustainable businesses, about building companies that can weather storms and survive beyond their founders. But we rarely talk about the financial sustainability, about the importance of not being over-leveraged, about maintaining cushions and buffers for when things go wrong. Musk's approach has been the opposite of sustainable in this sense. It's been about pushing everything to the limit, about using every available resource to move as fast as possible, about sacrificing stability for speed. And in a world where you're racing against time, where you believe that humanity needs to become multiplanetary soon or risk extinction, where you think electric vehicles need to be adopted immediately to prevent climate catastrophe, that approach makes sense. Sustainability can wait. The mission can't. But what if the mission requires sustainability? What if moving too fast, pushing too hard, creates its own catastrophic failure mode? What if the way to actually achieve these grand visions is slower, more careful, more financially conservative? These are uncomfortable questions for people who admire Musk's audacity, who want to believe that force of will and vision can overcome any obstacle, but they're questions worth asking. Consider Toyota for a moment. Not the most exciting company, not the one that makes headlines with bold promises about the future. But Toyota has been around for almost a century. It survived world wars, economic crises, oil shocks, currency fluctuations, technological disruptions, changes in consumer preferences, and emerged stronger each time. It didn't do this by moving fast and breaking things. It did it by being methodical, by building quality into every process, by maintaining financial discipline, by thinking in terms of decades rather than quarters. There's a Japanese concept called ikigai, which roughly translates to your reason for being, your purpose. And there's another concept called kaizen, continuous improvement through small incremental changes. Toyota embodies both of these. It knows what it is, a company that makes reliable vehicles, and it continuously improves at that mission through small sustainable steps. It's not sexy, it's not going to inspire movies and biographies, but it works, it lasts. Musk's approach is the opposite. It's about massive leaps, about disrupting entire industries, about achieving in 10 years what would normally take 50. And it's achieved remarkable things. Tesla did accelerate the electric vehicle transition. SpaceX did revolutionize space launch costs. These are real accomplishments that matter. But the question is whether these accomplishments can be sustained, whether the organizations can outlive their founder, whether the mission can continue when the charismatic leader is gone and the bubble has burst and reality reasserts itself. I don't know the answer to that question. Nobody does. We're watching it unfold in real time, watching an experiment in how fast human organizations can move and how much risk they can take and whether audacity alone is enough. It's fascinating in the way that watching a high-wire act without a net is fascinating. You're impressed by the skill and the courage, but you're also aware that one misstep could be catastrophic. And maybe, just maybe, that's the real lesson here. Not that Musk is doomed, because we don't know that. Not that the AI bubble will definitely burst because bubbles are hard to time and maybe this one has more room to grow, but that all systems have vulnerabilities, that all strategies have failure modes, that even the most impressive achievements rest on foundations that can crack. It's a bit like what we learned when we talked about the universe itself, about how space might end or go on forever. about how the laws of physics might break down at extreme scales, about how our understanding of reality is always provisional and incomplete. Uncertainty is woven into the fabric of everything, whether we're talking about quantum mechanics or corporate finance or the fate of empires, and maybe learning to sit with that uncertainty, to acknowledge it rather than pretending we know more than we do, is part of wisdom. There's a certain peace that comes from accepting limits, from recognizing that some things are beyond our control or our knowledge. Musk's empire might collapse when the AI bubble bursts, or it might not. He might adapt and survive, or he might go down in flames. The future is genuinely uncertain, and that's okay. That's just how the world works. We make our best guesses, we plan for contingencies, we try to see around corners, but ultimately we're all navigating by instruments that show us only part of the picture. So what do we do with this understanding? How do we live in a world of such profound uncertainty, where empires can crumble and bubbles can burst, and the richest person in the world can lose everything in a cascade of margin calls? I think the answer, or at least an answer, is to hold our beliefs and predictions lightly, to be curious rather than certain, to ask questions rather than proclaiming answers, to trace the connections and understand the vulnerabilities without pretending we know exactly how events will unfold, and maybe to be a little more skeptical of anyone who promises certainty, who says they know exactly what's going to happen, who claims to have it all figured out. Because they don't. Nobody does. The world is too complex, too chaotic, too full of feedback loops and emergent properties and unexpected interactions. The best we can do is identify patterns, understand systems, recognize vulnerabilities, and make informed guesses about what might happen next. In the case of Musk's empire and the AI bubble, I've tried to do exactly that tonight. I've laid out a scenario, traced the logical connections, shown how one failure could cascade into many. But I want to be clear, one more time before we end this journey together, this is a scenario, not a prediction. It's a way of thinking about risk, not a forecast of the future. It's saying, here's what could happen if these assumptions hold, not, here's what will definitely happen. The difference matters. Scenarios help us prepare. They help us think through consequences. They help us see blind spots and vulnerabilities. But they're not destiny. The future remains unwritten, influenced by countless decisions that haven't been made yet, by technologies that haven't been invented yet, by events that haven't occurred yet. Musk could change course tomorrow. The AI bubble could last another decade. Some breakthrough could change everything. We don't know. We can't know. And that's both terrifying and liberating. Terrifying because we like certainty. We like to feel that we understand and can predict and can control. But liberating because it means the future is still open, still full of possibilities, still subject to change based on the choices we make individually and collectively. If Musk's empire is vulnerable to the AI bubble bursting, then maybe he should reduce his leverage, diversify his dependencies, build more cushion into his financial structures. These are choices. They're not easy choices, and they come with trade-offs, but they're possible. And for the rest of us, watching from outside, trying to understand what's happening in the world of tech and finance and ambitious entrepreneurs, maybe the lesson is to look beyond the headlines, to ask not just, what is this person accomplishing, but how sustainable is the structure they've built, to appreciate both the audacity and the vulnerability, to hold space for both admiration and concern. Because here's something I've realized over many years of studying complex systems, whether they're physical systems like the universe, or social systems like economies or organizational systems like corporations. The most impressive structures are often the most fragile. They achieve their impressiveness by pushing boundaries, by operating at the edge of what's possible, by optimizing for performance rather than robustness. And that's fine. That's how progress happens, but it comes with risk. And when we celebrate these structures without acknowledging their fragility, we're missing half the story. The cathedral in Paris, Notre Dame, stood for almost 1,000 years, a masterpiece of Gothic architecture, a symbol of human creativity and craftsmanship and devotion. And then one day in 2019, it caught fire. Within hours, the spire collapsed. The roof was gone. Centuries of history damaged in an afternoon. Nobody thought it could happen. The cathedral seemed permanent, invincible. But it turned out it was just wood and stone and lead, vulnerable to something as simple as an electrical short or a careless cigarette. Musk's empire is kind of like that. Impressive, monumental even, built to last, or so it seems, but ultimately just a structure of debt and equity and stock valuations and investor confidence, vulnerable to something as mundane as a market correction, or a change in sentiment, or a cascade of margin calls. The grandeur doesn't protect against the fundamentals, the vision doesn't override the mathematics, and when the fire starts, when the first domino falls, the rest of the structure can come down faster than anyone expects. I want to end on a thought that's been percolating through this entire discussion, a meta-observation about why this matters beyond just one person's fortune or one set of companies. The AI bubble, whether it bursts next month or next year or 5 years from now, represents something larger than just a market correction. It represents a test of how we think about the future, about progress, about the relationship between vision and reality. We're living through an era of extraordinary technological change. Things that seemed like science fiction when I was young are now commonplace. We have supercomputers in our pockets. We have robots exploring Mars. We have artificial intelligence that can hold conversations and generate images and write code. The pace of change is dizzying, and it creates this sense that anything is possible, that all the old rules don't apply anymore, that we've entered a new era where growth can be infinite and limitations can be overcome through sheer innovation and will. The AI bubble is fueled by this sentiment, this belief that we're on the verge of artificial general intelligence that will transform everything, that will solve every problem, that will create wealth beyond imagining. And maybe that's true. Maybe we are on that verge. Maybe the technology will deliver on all its promises. But bubbles form when belief outpaces reality, when the future we imagine becomes more important than the present we inhabit, when we stop asking hard questions about fundamentals because we're so captured by the vision. And when bubbles burst, they teach us painful lessons about the difference between vision and reality, between what we hope will happen and what actually can happen given physical constraints and economic realities and human limitations. The dot-com bubble taught us that having a website doesn't automatically make you profitable. The housing bubble taught us that real estate prices can't rise faster than incomes forever. The AI bubble, when it bursts, will teach us something about the limits of artificial intelligence, about what it can and can't do, about the difference between impressive demos and transformative products. These lessons are valuable, even if they're expensive. They're how we collectively learn, how we calibrate our expectations, how we separate hype from reality. And the people who get caught in the burst, the companies that fail, the investors who lose fortunes, the entrepreneurs who lose their empires, they're paying the tuition for the rest of us to learn. It's not fair, but it's how markets work, how economies evolve, how technological progress actually happens in the messy real world rather than in tidy narratives. Musk, if our scenario plays out, would be paying that tuition. His empire's collapse would be the object lesson, the cautionary tale, the case study that business schools teach for generations about the dangers of overleverage and the limits of visionary leadership when financial realities intrude. And maybe there's something valuable in that, even for him. Maybe starting over, building something new without the weight of all that debt and all those expectations, would be liberating in its own way. Maybe the next act, if there is one, would be more sustainable precisely because it's informed by the lessons of failure. Or maybe I'm being too philosophical, too generous with interpretations of what would be a genuine catastrophe for him, personally, and for everyone who works at his companies and for everyone who's invested in his vision. There's a tendency sometimes, when we talk about these large-scale economic events from a distance, to forget that they represent real pain for real people. Job losses, retirement savings evaporated, dreams deferred or destroyed. The mathematics and the logic and the systems-level analysis can make it all seem abstract, like pieces moving on a board game, but the consequences are concrete and human. So let me be clear. I'm not rooting for any of this to happen. I'm not hoping the AI bubble bursts or Musk's empire collapses or any of the other scenarios we've explored tonight. I'm simply trying to understand the vulnerabilities, to see the structure clearly, to trace the connections that most analysis ignores. Whether it happens or not, whether our assumptions hold or not, the exercise of thinking it through has value. It helps us see the world more clearly. It helps us ask better questions. It helps us make more informed decisions, whether we're investors or entrepreneurs or just citizens trying to understand the forces shaping our world. And maybe, in the end, that's enough. Maybe the goal isn't to predict the future with certainty, but to understand the present with clarity, to see the systems we're embedded in, the vulnerabilities they contain, the ways they might fail, the forces that shape them. To hold all of that in mind while accepting that ultimately, we don't control outcomes, we only influence them at the margins. There's a humility in that recognition, a letting go of the fantasy that we can know and control and predict. And maybe that humility is what we need more of, both individually and collectively. Maybe we need to be less certain, more curious, more willing to say, I don't know, and here's what might happen, rather than proclaiming definite outcomes with unwavering confidence. The universe, as we've explored in previous journeys, is fundamentally uncertain at the quantum level. The future is literally not determined until it happens. Maybe our economic and social systems are the same way, not because of quantum mechanics, but because of complexity and chaos, and the impossibility of knowing all the variables and their interactions. Maybe the right response to that uncertainty isn't to pretend it doesn't exist, but to embrace it, to work with it, to make our peace with not knowing, while still trying to understand as much as we can. So sleep well tonight, dear listener, wherever you are in this strange interconnected world of ours. Whether you're in Tokyo watching the sunrise, or in London watching it set, or somewhere in between watching it hover at that peculiar afternoon angle that makes everything look golden and temporary. The markets will open and close tomorrow, just as they did today. Bubbles will continue to grow until they don't. Empires will rise and fall, as they always have. And through it all, we'll keep exploring these questions together, gently, thoughtfully, without urgency or alarm, just curiosity, just wonder, just the shared human project of trying to understand the world we find ourselves in. Thank you for spending this time with me tonight. Thank you for following this long, meandering exploration through financial vulnerability and corporate fragility and the hidden connections that make our world more precarious than it appears. If this sparked something in you, some new way of seeing, some question you want to explore further, leave a comment below. Tell me what you think. Tell me where you are. Tell me if I missed something important in the analysis, because I very well might have. This is complex stuff, and I'm learning right alongside you. And if you enjoyed this slow drift through economic uncertainty, if you found value in taking the time to really think through how systems work and where they might fail, hit that subscribe button. Ring the notification bell if you want to be alerted when we explore something new next time, whether it's quantum mechanics or consciousness, or the heat death of the universe, or the next financial crisis waiting to happen. Share this with someone who appreciates thoughtful analysis over breathless hype, who values questions over answers, who's willing to sit with uncertainty and complexity. The world needs more spaces for this kind of thinking, for slow contemplation in an age of rapid reaction, for nuance in an age of hot takes, for uncertainty in an age of overconfidence. Every subscriber, every like, every comment helps create that space, helps tell the algorithm that this matters, that people value depth and thoughtfulness, and the willingness to explore ideas without necessarily resolving them. From the sleepy scientist to you, wherever and whenever you are, sleep tight. The markets will still be there when you wake, doing whatever incomparable things markets do. Musk's empire will still be standing or tottering or something in between. The AI bubble will be growing or shrinking or preparing to burst. And we'll be here too, ready to make sense of it all together, one gentle thought at a time, one long exploration at a time, one moment of shared curiosity at a time. Rest well. Dream of electric sheep or balanced portfolios or sustainable business models or whatever brings you peace. The future remains unwritten, and that's beautiful in its own way. Good night.